Okay, ladies and gentlemen, yes, we are back again with another urgent warning. Now, I seem to be getting a lot of stick about this story about the carry trade unwind, but that obviously explains because people don't understand what this actually means. You see, the last carry trade unwind was on August the 5th of 2024. So you can appreciate that when that happened, the stock market took a tumble for the downside because the Bank of Japan had increased their interest rates. But what I'm going to do for you today is bring you into an understanding of why there is data that is backing the idea. And not to forget the fact that all week and even last week, they have been saying ex-ministers of the Bank of Japan and current board members, and of course, Takachi herself even stating that there is a possibility we're going to hike the rates in April. Now, just stick with me here. I'm the messenger. I just want to give you the information because I'm going through it myself when I'm taking trades and trying to understand my trade regime and macroeconomics behind it. Take this information and then say to yourself, yeah, he's got a point. Or, nah, forget it, man, FUD, moon boy to the moon and all that stuff. You want to stay in there? That's cool. There's no problem there. But at least I know I've served you in one way because I know that this information is going to make you think, maybe. So what we're going to do firstly is break down this story of what's going on in regards to the Bank of Japan. I'm going to break down a little bit of Bitcoin price action for those guys who just want to know if Bitcoin's going to go up or down. I mean, we're in a bit of a difficult situation given that yesterday the good old FOMC minutes came out with some interesting flavor that we're going to have higher rates for longer. Yeah, don't sleep on the dollar. Don't. Whether you like to admit it or not, yes, it's the most violated currency on earth, the most artificial thing that existed. Even the paper that it's made on it's just fake and it's just a glitch. But it's the legacy markets, and this is the thing that we use. What's going on with BRICS? Anything happening with BRICS, like coming away from the petrodollar standard? Yeah, ever since what happened to Venezuela, and then, of course, Trump putting out that story regarding Cuba. Anyone that buys anything off Cuba is going to feel the wrath of Trump. I don't see nothing going on with BRICS. Do you? Anything? The SARM rule. Yes, there's that story as well. Let's break it all down, get you guys informed with it. If you are new, welcome to Traders Reality. I break down the macros, I throw in some trading, I give you my logic, but I know that what I'm giving you is, in my opinion, hopefully going to be serving you all when you do sit down and have that conversation with your best mate and his dog. Should you buy Bitcoin now or not? I hope this information is going to serve you. Let's get with the program, ladies and gentlemen. Hope you all had a wonderful morning. Let's get with the flavor. Here we go. So, stocks fall as US-Iran worries drive oil higher. Problem we've got is macroeconomic data or events-based risk is what is leading this marketplace to do what it's doing. Bring it into perspective. You can see, Bitcoin making a move down to the downside. But something that you want to be understanding is this. When you look at the ebb and flow of the way the markets are operating, let's just take, again, last week's inflation data. That came in lower, well, the year on year. NASDAQ makes a wonderful move on the inflation data. Where was it? Here it is. This moved to the upside on Friday the 13th, and then, of course, came and gave it all back again. That's no good. If inflation's coming down, that should be a welcome thing. That means interest rates should be getting decreased. Yeah? According to investors, that's not the case. Let's go and have a look at what happened yesterday. We saw some nice movement to the upside on the possibility of the Iran talk starting to calm down again. But then, of course, the bigger picture with regards to interest rates is still a problem because Fed Bar came out and said that unless goods inflation comes down, then we've still got the problem of inflationary pressures. Stock market brought price all the way back down again. So it just goes to show you that investors are very fickle with the way they're perceiving things. And the main theme that you've got to understand is, as long as interest rates are still high, the yield on the dollar is going to be sought for. That's all it is. You're always going to have that problem of dollar power going up because it serves them to hold on to an asset that they can earn interest from. If you want to earn interest from gold, you can't. Well, depends how it's purchased in some aspects. But the basic premise is gold is a zero yielding asset. There is no interest rate attached to gold, but it reacts to interest rate changes. So why should an investor stay in a dollar if the yield on the dollar is going down? They'll go over to gold because they'll speculate that gold's price will go up. Equally, if the rate on the dollar is going to be higher for longer, then I'm not going to go into gold because I have to rely on gold's price going up in order to make a return. So I may as well get myself in some dollars and just hold them. And the yield that is being generated on the dollar, I earn from. Happy days. Now, let's just get into the logic of what's going on with this story. A BCA research guy comes out and says yen carry trade is a ticking time bomb. I'm waiting for all the old, oh, not this story again, not this guy again, okay? Just stick with me on this one. The problem we've got with this carry trade is it is so closely tied to the US dollar. Carry trade in a small sentence is like this. You borrow yen, okay, because the money rate on the yen is very cheap, okay? You then get that yen and convert it over into dollars. You then put those dollars into the stock market. Happy days, all right? You've exploited a cheap currency, gone and exchanged it into a currency that has higher rates, and you've avoided having to pay interest rates on the dollar because you're not borrowing dollars. You're now converting your yen into dollars because it's cheaper to borrow. Now, when the carry trade unwind comes into play, what happens? Well, the cost of doing business before was very cheap, but if they're increasing their interest rates on the yen, that means anyone that borrowed money before is now going to incur a higher cost of that borrowing. So what do? They go to the stock market, sell those stocks, get those dollars, convert the dollars back into yen. The yen goes up, the dollar goes down. That's your carry trade unwind. And the reason why people are so in fear of it is because it does lead to aggressive volatility spikes in both currencies, dollar and yen, because everyone is trying to convert back into the yen to avoid the additional fees off the back of the idea that they're increasing the rates on the Japanese yen. That's your carry trade. Now, let's just go into understand why this increase could lead to a carry trade unwind, which might be quite catastrophic if it does actually play out. First things first. Just recently, the IMF has been urging Japan to avoid cutting sales tax amid higher expected borrowing costs. Takechi has come into play with her successful election saying, I'm going to cut the costs of doing business by reducing the taxes, and I'm going to be pumping up the spending. Japan is famous for this Japanese miracle, which says that they can accumulate so much debt, so much, and yet still actually keep things going and everything is all good. Well, the IMF is urging them to just chill out a little bit because by cutting the taxes, you're going to be causing a little bit of a problem for your debt because the debt issuance is just going to be shooting up and you can't really be maintaining that. Well, let's just look at something in front of you. Basic policy from Prime Minister's Office of Japan. Basically, when you read this document, the one thing that could lead to the idea that they are planning on increasing the interest rates is to go into a case of, where is it? Responsible and proactive public finances. The problem with Bank of Japan is they've been borrowing or lending out their money at such a cheap rate that it has devalued their currency so badly, which is why we've had this problem with Japanese bond investors. They're holding on to the Japanese bond, which is effectively saying, look, my currency or the yen is so devalued. My bond is pointless. It's not worth anything. If you keep on cutting taxes and reducing the income for the Bank of Japan or government per se, then I'm holding on to a bond that is deemed as worthless because my currency is so devalued. Okay? This document here is starting to identify that by saying they're going to be responsible and proactive with public finances, well, by every time they do increase the interest rates, the last increase led to $168 billion worth of income interest to go back into households. So she's serving the public by pushing more money into those households, by increasing the value of the yen, thus making the investors who are holding the bonds hold on to them at the point that they can actually see a return in those bonds by holding on to a valuable bond. Why? Because the yen will be increasing in value. Okay? This basic policy story just identifies her plan with things, which has got the IMF a little bit concerned about it. Now, let's just understand something very important. In front of you is this chart. What does this say? It's a basic blue line. This is the 5-year credit default swaps for the Bank of Japan, okay? Or Japan for the better word, okay? Down below, you can see And we're starting to see a little bit of movement to the upside. That is not very good, ladies and gentlemen. The problem with this is it's implying that over a 5-year period, the possibility of faults or credit default swaps being exercised, or for the better word, things not looking good in terms of fiscal monetary policy, and there's going to be a default in risk as such. If that starts to rise, the expectation is that people think there is a problem in the next few years. We need to cover ourselves, so they're buying this up. That's no good. So how do you actually contain investors' view or pessimism towards the Japanese economy or the future of the bonds and the future of the yen? How do you divert their attention away from that? You increase the rates. Just this one chart shows all of that, okay? Come look at this chart. In front of you is the 30-year bond yield against the dollar index. The blue line is the 30-year bond yield. That's starting to come down, and the dollar itself is starting to base out, okay? When the yield on the 30-year bond of Japan starts to come down, it means investors are going into yen. Doing it very slowly. You see, the thing that we got with the dollar right now is you've got the possibility of interest rates being higher for longer. Today, we've got Kashkari coming into play. Who is Kashkari? Well, ladies and gentlemen, in today's trade document, as I give out to all the members of the Platinum membership, which is a trading regime, I mentioned that a major speaker today is Kashkari speaking at 2 p.m., which currently could be speaking. I'm waiting for some information to come out. If there is anything being said, nothing has been mentioned or anything. And we've just had notifications saying UK is blocking Trump from using bases for strikes on Iran. Well, oil. I'm going to be getting into that very shortly. But this is really important because if Kashkari today reveals that he is leaning more towards a hawkish approach, then, ladies and gentlemen, interest rates are going to be higher for longer. The dollar is going to keep on climbing up. And then Bitcoin is going to be coming down. Equities will be coming down. But more importantly, taking it back to the point of the Bank of Japan, if the dollar itself keeps on going up, then we have this problem of what? The dollar yen. If that keeps on going higher, then what does that mean? Forex intervention by the Bank of Japan. So we've got two slaps in the face. We could have the carry trade unwind, which means that the interest rate increase on the yen is going to come in and force investors to get risk out of dollar and put it back into yen. Equally, if the dollar keeps on going up and dollar yen gets up towards the range of 160, that is consistent with Forex interventionary levels for the Bank of Japan, which means that they will be dumping US treasuries into the marketplace. That means they're dumping dollars. That's going to force the dollar to go down and investors will be going over to the Japanese yen. So you can appreciate, with all the information that we've got about the Bank of Japan and the approach that they're actually exercising, it's all being engineered to bring the yen back up. But is it finished there? No, not at all, ladies and gentlemen. You think I'm just going to come with that? I just want to get the naysayers out of the way. Here we go. What's this? Commitment of Traders report. The last time I mentioned this sort of report was on a post on Instagram talking about gold. I got so much shit for that. And everyone was like, it's going up, it's going up. Then all of a sudden, it all went quiet because gold took a shoe bag to the downside a week later. And that was me revealing the positions of the Commitment of Traders, that they were net short on gold. Anyways, never mind. You live and you learn. In front of you are the Japanese yen futures. Commercials are coming in with an increase on their short, on their long positions. Equally, non-commercials are coming in with long positions, but they are also short at the same time. But we expect that with non-commercials because they're using it possibly for hedging purposes. Okay, but now this is where it gets a little bit interesting. In front of you here is the banks. If I just go to the top of it, it says here, banks participation report. Now, for the Japanese yen, what we're seeing here, where is it? There we go. What we're seeing here is there is more banks stepping in, okay, participating in net longs in the futures of Japanese yen. So already there is an expectation that the yen is going to go up. Interest rate increase possibility, okay? The possibility of the dollar yen, okay, that going into Forex interventionary levels. The IMF warning Bank of Japan, Takachi, to be very cautious about her sales tax story. The 5-year credit default swaps rising with the expectation that things might not be looking good. So you got to do something, increase the rates. It's all being engineered to trigger, in essence, the carry trade, because there's nearly $5 to $6 trillion worth of carry inside of that. Because the last unwind that came into play on August the 5th, 2024, what was that? Well, when we had that carry trade, there was roughly around $4 trillion left, and everyone was looking left and right as to be like, what's going to happen next? Are they going to unwind that? Luckily, they didn't, and then everything shot back up again. Now we're around the $5 to $6 trillion mark, okay? Because a lot of money's going over into the money markets, and that's coming into around $7.5 trillion in increase. And the last couple of weeks ago, there was about $89 billion being pumped back into the money markets. That's no good, because you need them to go into the stock market to add the risk and make sure that they're taking a commitment on buying the stock itself rather than buying a basket of stocks, because they want to diversify, okay? That is where I'm at with the Bank of Japan and that story. I mean, look, Bank of Japan policies and higher yields add pressure to carry trades, all right? But these two charts here, the fact that the 30-year bond yield is going down, but the dollar is coming up, means that they're going into yen, and the dollar is only going up because investors are seeking a rate of return on the back of the fact that interest rates are going to be higher for longer. Credit default swaps, they need to contain that. The last time it spiked up was 2020. And what was going on there? COVID. They regulated it, don't need to worry about it anymore. Bang. Comes back down. They regulate. For every time they actually spiked up, look at this. What was this? You see that? That range, credit default swaps, 2023, okay? And then we go into 2024, it comes back up again. It all carry trade unwind ranges, okay? That's what you got to take into consideration, ladies and gentlemen, all right? I don't mean to wind anybody up, but you've got to understand the mechanics of the way the market moves. If you understand and study money rotation and use these sort of charts to aid you in understanding the bigger picture of things, it's not going to happen overnight, man. You know, how long have people been calling for Bitcoin to go to 100K? And look how long it took. You held on and retained the idea of it going to 100K. It hit 100K eventually. But with the way that things are moving right now, ladies and gentlemen, these carry trade unwinds, the concept of risk is getting higher and higher. And the fact that they're trying to keep the rates on the dollar higher for longer because they're trying to contain inflation, well, let's just look what happened today. We've just had another reading that the unemployment claims came in lower. Welcome to inflation. Then we had the story right now about the UK blocking Trump. You're going to really piss Trump off. That's tariff worthy in my opinion, but there we go. Oil going up $66, and the latest inflationary reading hasn't factored in the fact that oil's price has been going up. But now we've got more people that are claiming, well, less people claiming benefit. We had a storming non-farm payrolls read suggesting that there is more people available to go out and work, and they take on the jobs, which effectively means what? Well, the unemployment rate came in lower at 4.3%, the lowest in however long it's been, 50 years, and that is courtesy of Biden, anyways. You've got inflationary triggers coming into play all day, every day. It's just waiting to happen. We're going to get that nice reset. I'm telling you, the market drops from the levels that it's at. Start buying it on the cheap, because OpenAI is coming in with a $100 billion investment with Abu Dhabi. You've also got Meta joining forces with NVIDIA, even though Meta were really snubbed NVIDIA, okay? Now they're joining forces together to create millions of chips. It's now all about data infrastructure, okay? Spend the money. Everything drops. Expectations come in and say, all right, we're not going to earn anything right now. So the market corrects. Then everything drops. You buy everything on a discount. Then you start seeing all the earnings per share coming out, and they're just doing great because they've got all the data center infrastructure sorted out. They've made the investment. Partnerships coming out of every backside that everyone knows, and then happy days, your market continues with the bull run. But interest rates are still high. That's it. That's what's going to force the markets to drop. Kashkari comes out today and leans hawkish. We're done. Barr, who was already on the fence, has leaned towards a more of a hawkish stance. That's two people on the voting scheme over here that are not neither here nor there. Barr has come out saying we need to have rates higher because they were hawkish yesterday, okay? Kashkari today, if he comes out hawkish, we are pretty much done and dusted that interest rates are going to be higher for longer. And to put matters into perspective, we've got a Bitcoin being sold right now by BlackRock. We're seeing so much selling being put into Coinbase Prime Deposit, going over into Bitcoin's price actions to put things into perspective. We've seen a little bit of a move to the downside. Bitcoin does have a very important range right now, but sentiment across the board is not saying risk on. It's just not saying it yet. And if it is, it's going to be for a short period of time. You are driven by events-based risk. And as long as you are on top of your news and you're keeping aligned with escalatory and de-escalatory events, then, ladies and gentlemen, you're not going to be caught up in any surprises other than when anything happens, like just now. UK blocking Trump from using bases for strikes in Iran. What does that mean? Get ready for gold, ladies and gentlemen. What does that mean? Geopolitical risk. What does that mean? I ain't going to be sat in stocks. That's a problem. Maybe if I go over to defense-based stocks, that's going to be a benefit. Well, Japan are increasing their spending on defense as well. So look at that. Everyone's getting ready for war. It sounds so overwhelming, doesn't it, ladies and gentlemen? Yes, it does. But I try and give you as much of my experience as possible in a short period of time. But what you've got to do is just keep on playing the game. Read the titles. All right. Stocks fall. Iran worries. What can I get from that? Oil higher. Stocks are going to go down. Gold is going to go up. Commodities overall are going to be increasing. I've got my Japanese yen story that is developing. Okay. They are forcing the strength of the dollar to go up. They are forcing it. And when they hit that key level, that means you can then do what? You got to think out of the box for this one. If your dollar shoots up and appreciates, what a perfect time to sell stock. Why? Because now you've got worthy dollars. Which means that when you sell the dollars at the rate of above 100, you've just earned yourself an appreciation, okay? Then when everything sinks, you step back in and use your dollars because the purchasing power is higher. Okay? That's my expectation, ladies and gentlemen. That's exactly what it is. And listen, tonight, I'm doing a video, okay? For anybody new, I'm doing a video, and it's a quick scalp on Bitcoin. I'm just going to show you here, all right? I'm going to break down the logic of this trade that I had on Bitcoin. Shared it in the Discord with the members, and I'm going to break all of that down in a video for you this evening, okay? So if you're a Bitcoin trader and you want to try and exploit the hybrid system the way that I do it, then this video is going to help you understand it. We're going to break things down, marry up concepts together as to how you can take advantage of quick scalps. This was only, the move itself on Bitcoin, that was the play right there, and we were trading back into the red vector candle range. I'm going to explain to you what that is, okay? And it was only about what? I think it was about a $800-900 move on Bitcoin. And people want the moonshot. But in the process of, they're going to end up losing their brains because they're using too much leverage and they get shaken out left, right, and center, okay? So I'll be explaining that for you all later on, okay? Do we have any questions? Yes, that is very sure. That is correct, Hawk Merlin. That is correct. Yes. Oh, my days. Is there any risk to be had right now? Yeah, this was the trades from last night, yesterday in that scalp. I'll show it you later on. Just tune in later on and you'll see it. But there was the entries there, okay? We managed to sell at the top side of the range right there, and Bitcoin took a shoe bag. That's why I say to you all, always sell into strength. Look at where I'm selling. Look at where I'm buying. Look at where people are going short. Look at where people are going long. How messed up is that? That is this typical explanation and this breakdown every day with these liquidations. And hold on, let me just get them up for you. Where is my heat map? My heat map. There you go. My order book thing. Look at that. This stuff right here, it gives you the clue. It tells you exactly what the story is with the bids and the offers. Who's buying and who's selling. As long as you understand that, guys, you should be good in this game. Tino, when is the next bull run for your hair beginning? The bull run for my hair is, I don't know, actually. I don't actually know. If we decide to grow it, we'll grow it. Will VIX go as high as 2008, 2020? A physical, right, listen, this is the issue that we've got. Okay, let me explain, right? We are not in what is called a problem with the financial market, or finance for the better word, okay? If we consider the credit spread, okay, right now, it's at very, very low levels. Wait there. Let me just pull that up for you just so you guys can see what I'm talking about. Credit spreads, okay? If the credit spreads are all good, then we don't really have anything to be too concerned about. Let me just have a look at the credit. Here we go. Credit spread and the volatility index. Right, look at this, okay? So this is a really important chart. Now, look, down here. Oh. Oops. I may have spoken a little bit too soon. Okay, no, we're still good. We're still good. You see this little blue line down here, okay? This blue line starts to go up significantly. There is a problem. Credit spread. That could lead to inversions on the yields, or there is an issue for credit. They need the credit, so liquidity is low. That's why spread's getting wider. And we're not seeing that happening right now. So from a credit perspective, yeah, there's probably going to be defaults all over the place. But from a credit perspective, there is nothing to be too concerned about. The issue that we've got is the rate of doing business is still expensive. That's the problem we've got. And we're not in any clear path rate just yet. Easing cycle. Well, we were on one once we cut the rates, but then all of a sudden it stopped because inflation is still not doing its job. Or should I say, it's not coming down. It's still sticky. If the core CPI came in higher than the previous reading, yet year on year inflation has come in lower, then they can only make the assumption that it's just because of a seasonal change. Now that you've got increases in oil's price and you've got geopolitical tensions increasing, and then we've got Donald Trump who's going to be making an announcement later on, and the fact that the UK has blocked the US from entering in certain spaces, that's just going to encourage another war premium. Welcome to gold going up. Welcome to the dollar going up, because investors will go into gold to protect themselves for the next event. What was I saying yesterday? That's exactly all it is, ladies and gentlemen. When you marry the idea of macros together, you can then come with a picture and say, yeah, man, this is something that I can exploit. Capiche? Okay, then. All right, then. Other than that, ladies and gents, I hope that makes sense. Mad love and respect. Be sure to like and subscribe, and I'll be tuning into you all later on. Actually, you know what? The market's about to open. Sit tight. Let's not go. Hold on. Don't go nowhere. Tino, when the camel trade unwind. What a guy. Camel trade unwind. Okay, why wasn't there any really market movement when Japan raised the interest rate 0.25% back in December? Great question. It's because the fact that the dollar yield, in my opinion, it's because the yield on the dollar was so low, as in the dollar currency itself. All right? It was very, very low. And they need to go up by at least get to about 1.25%. And on top of that, currency-wise, in terms of extremes, it wasn't that bad. Okay? But we are heading into extremes because of the dollar. And that's something you've got to be very mindful of. If the dollar yen keeps going up, then we are having a major adjustment in the carry unwind. I believe they need to make sure the dollar gets up to a point of value which is deemed as worthy before they can unwind things. That's what I think. That's what it is. Here we go. Market's open. Let's have a look at NASDAQ and see what that's saying. Okay, then. NASDAQ pre-market. Any activity? Let's just go over to the QQQ. QQQ's playing sideways. We've got a little bit of a gap down here that we need to be careful of, even though they tapped it. Volatility index, where you at? Be very careful, ladies and gentlemen. VIX is trading positive and the NASDAQ's moving up. All right, so just be very cautious with that. Be very cautious. Oil coming down a little bit. Let's just go and have a look at pound just to see if there was any activity. Clearly not. Euro saying sayonara. Dollar dominance is coming in with a nice sweep, continued upside. Gold itself sideways. That's a problem. Look, here's the clue, right? When gold goes sideways and dollar goes up, that's a bit of an issue because it means they're retaining gold. They're building the position. Get ready for the next hedge, okay? Get ready for it. I'm telling you now, gold is going to spike. It's going to move. I've said it once and for all. Here, it's going to go back into this range. It is going to rip up, okay? That will be the perfect storm, all right? You've got to wait for the event. Can you absorb the up, down, up, down, up, down? If you can, happy days. Wait for the next event. That's all I'm saying. Stumpy G, of course I remember you, man. Flipping hell. Tino, when should I move my 401k to dollar fund to protect assets? The problem that we've got is you've got to wait. This is the issue we've got, okay? The problem is, because of where we are with interest rates, okay, there's neither, we're humming and ahhing about whether we're going to get the cuts or not, okay? But we do have this policy where it's saying that we're going to get rate cuts. So if we just had that problem with rate cuts, then it will be easier for you to start maneuvering your capital into safer assets like certain ETFs, like income-based ETFs or REITs and what have you, okay? Because the rates are still high, all right? Mortgage rates are still high. It's still above the 6%, and people don't like that. Even though they came down, they're still high. So the expectation is that rates are going to be higher for longer, so mortgage rates go up because that's what they're doing, okay? But because you've got geopolitical tensions and you've got a very active president that is not scared to say and distribute his vitamin C across the board, as in the orange anyway, forget that. What I'm trying to say to you is geopolitical events are going to be maneuvering other asset classes and making them be volatile because people are like neither here nor there. This thing with UK, this thing with Iran, they're going to be agreeing to a compromise. Now they're not. Now we've got this story here with Iran trying to build concrete shield at a military site. What the hell are you talking about? Builder, what? What are you waiting for? So these are all things that are going to be forcing investors to stick to the narrative and go to what they know. That is your golds, your silvers, your palladium, your platinums, your coppers, your oils, all commodity based, okay? When there is a war, you have to seek commodities, coffee, wheat, soya, okay? These are the things you want to be trading because anywhere that there is a war could impact the supply or the flow of the wheat. We could be going to shortages depending on what's getting hit. These are so many things that you have to factor in just before you say, yo, Tino, should I move my money here? Should I move my money there? There's so many things to factor in, Takes a little bit of work, my brother. I'm going to say it properly. What's better, gold options or future trades, Tino? In my opinion, gold options are much better to trade. And the only reason why is because you can factor in a little bit of a longer time frame. Futures options, futures trades, you got working with leverage, like aggressive leverage. And, there's really fast movements in there. But when you're playing options, you have to factor in the longer time frames. Okay. You can do the same thing with futures. You'll be better off playing spot, if I'm honest with you. But yeah. Don't forget aluminium. Yes, T, you should check out Night Eye extension for your browser for your eyes. Yeah, I understand. I know that. F.Lux I use. Treasure, I don't know if... Yeah, sorry. Okay, then. With that being said, mad love and respect, guys. Hope you enjoyed today. And forgive me if I gave you any FUD today. But according to statistics, it says here that is FUD backed with data really FUD? And you're all on the bench with it. Here's your poll. Happy days. Mad love and respect, gang. Peace.